So imagine for a second that you founded a startup,
Yeah.
right? Just, tinkering away in your garage.
Yeah, the classic American dream scenario.
Exactly. But fast forward a few decades, and that little startup has just exploded.
Yeah.
It's become this massive, unstoppable corporation, and it now has like 7 billion stakeholders.
Wow. Okay. That is quite the scale up.
Right. And the supply chains, the tech, the consumer markets, they are all just deeply, irreversibly intertwined at this point. You still have a lot of voting power as the founder, sure, but you definitely don't have total control anymore.
I mean, how could you with 7 billion people involved?
Exactly. And the most terrifying part is if you get frustrated and try to just, pull the plug and shut the company down, you will immediately bankrupt yourself.
Because you're too tied into the very system you created.
Bingo. And according to legendary investor Li Lu, that scenario, it isn't just some hypothetical thought experiment. That is exactly what has happened to the United States and the global economy over the last 30 years.
It's honestly a brilliant way to visualize the sheer scale of the board we're all playing on right now because, as humans, we are sort of hardwired to look for a steady hand at the wheel.
Right, someone in charge.
Exactly. But when you have a startup with 7 billion stakeholders, that single hand just doesn't exist anymore. The organism is too big.
Which is exactly why today we are looking at a masterclass from someone who has navigated these exact turbulent waters and with just incredible success. So welcome to today's deep dive. We are jumping into a comprehensive transcript of a talk by Li Lu.
And if you are familiar with the finance world, that name carries massive, massive weight.
Oh, for sure. I mean, he is a legendary asset manager.
Yeah.
And famously, he's one of the very few people that the late Charlie Munger ever actually trusted to manage his own money.
Which really is the ultimate endorsement in the investing world. I mean, Munger was notoriously skeptical of, well, almost everybody.
Right.
So earning his trust required just an unparalleled level of rationality and insight.
So the goal today is to really unpack that insight. We want to understand his view on the mechanics of global economics, break down how he actually approaches value investing, and, figure out how to compound not just wealth, but knowledge over a lifetime.
Because the underlying message in this source is fascinating. It's this idea that if you can learn the mechanics of how the world actually works, and if you can learn to kind of zoom out, you can turn all the chaos of the modern world into a massive competitive advantage.
And to understand those mechanics, I think we have to start with that runaway startup analogy.
Yeah, let's dig into that.
Because Li Lu frames the last 30 years of globalization as an absolute anomaly in human history.
It really is. I mean, historically, whenever you had unified, globalized markets, they were stitched together by force.
Right, like military conquest or empire.
Exactly. You had colonial empires or very strict, rigid political alliances dictating who could trade with who.
But modern globalization, the one we've seen over the last few decades, was driven almost entirely by the free market. It was just companies looking for, the cheapest labor, the best resources, and the absolute most efficient supply chains.
Just completely ignoring borders to get it done.
Right. And here is where we hit the core friction we are experiencing today. Free markets, by their very nature of just relentless competition, they inevitably create winners and losers.
Which is the engine of efficiency, right? That's how it's supposed to work.
Yes, but when a free market creates losers on a national level, say, an entire domestic industry gets wiped out by a cheaper supply chain overseas, usually a single government steps in to act as a shock absorber.
Right. They do what economists call a secondary adjustment.
Exactly. So they introduce welfare programs or unemployment insurance, or they invest heavily in public education to retrain those workers. They actively redistribute wealth to keep their society from just fracturing.
But the problem is when you zoom out to a global scale, there is no single world government to perform that secondary adjustment.
Wait, what about the UN or the IMF? Don't they do that?
I mean, they try in certain ways, but no. They simply don't have the power, the budget, or frankly, the mandate to act as a global shock absorber. They can't redistribute wealth across borders in any truly meaningful way to offset the massive disruptions caused by free trade.
So we basically have all the friction and displacement of a ruthless global free market, but absolutely no global HR department to smooth things out when millions of people lose their livelihoods.
Which perfectly explains the immense political tension we see right now all over the world.
And the source material actually explicitly touches on how this friction has played out in recent U.S. politics. And just to be super clear to you listening, we're simply conveying the speaker's analysis here to understand his perspective. We aren't taking any political sides.
Right, we're just unpacking the source.
Exactly. But Li Lu viewed the previous U.S. administration's approach to these global tensions as highly chaotic, and he argued that it fundamentally hurt American interests. But he also expressed a lot of optimism that current leadership in the U.S. and China, along with coalitions like the G20, will actively guide things back to a more rational, cooperative framework.
And he backs that optimism up with a very strong mathematical argument. He basically says that true decoupling, like countries completely isolating themselves or returning to a hard Cold War stance, it's practically impossible now without mutual destruction.
Yeah, the phrase he uses in the talk is wild. He says trying to decouple would be like killing the 1,000 enemies to lose 1,000 of your own.
Wow, yeah, because a single unified global market creates the absolute highest level of technological and economic efficiency. If a country decides to completely isolate itself today, its tech degrades, its efficiency plummets, and it just loses its competitive edge entirely.
Okay, but if the global economy is this unstoppable, highly efficient organism, but local politicians still need to protect their own citizens, what actually happens next? Like, how does a government protect itself if it realizes it relies entirely on a foreign supply chain for, say, critical microchips?
Well, according to his analysis, we won't see a total fracture of the global market. Instead, we're entering an era of what Li Lu calls overlapping supply chains.
Overlapping supply chains?
Yep.
What does that look like in practice?
It means governments are going to force their own political layer of secondary adjustment onto the free market.
So a company might naturally want to use the absolute best, cheapest global supplier for a part, but their domestic government will step in and mandate that they also spend millions cultivating a local supplier, right? Like just as a backup for national security.
Yes, exactly. And that makes things incredibly messy. It's expensive. It creates massive redundancies.
But the core structure doesn't break.
Right. The core single global market won't shatter. It will just become a highly complex, politically managed web.
Okay, so if the global economy is this heavily politicized, unstoppable machine, I think the obvious question for you listening is, what does that mean for the rest of us? Like, how is an individual supposed to survive, let alone thrive, when the macro environment is just that turbulent?
It's the ultimate human dilemma, isn't it? And to address how we navigate this on a personal level, Li Lu brings up the Nobel Prize-winning novel, Dr. Zhivago.
That is such a vivid connection to make, because the entire premise of that story is about individuals, people just trying to live their lives, go to work, fall in love, getting completely battered and swept up by the massive historical tidal waves of the Russian Revolution.
Right. The individual is essentially powerless against the tide of history.
Yeah, the tide of history doesn't care about your personal 5-year plan.
It really doesn't.
Yeah.
So how do you cope? Well, Li Lu's solution is a psychological shift. He says you have to zoom out.
Zoom out.
Yeah. If you look closely at your own life in the short term, it is full of terrifying bumps, massive hurdles, just seemingly insurmountable obstacles. But if you take a longitudinal view, if you step back and look at the grand forest of history, those terrifying mountains in your own life are actually quite flat.
And to illustrate this, he points to modern China in the talk. He argues that despite all the complexities of the current geopolitical climate, today's Chinese citizens are arguably the luckiest generation in the last 200 years of their history.
Which is a bold statement, but when you connect that back to our global startup analogy, it makes perfect sense.
Right, because they were the biggest beneficiaries of that unprecedented global interconnectedness. You had hundreds of millions of people transition from an agrarian third world reality to a digitized first world lifestyle in a span of just 30 years.
Historically speaking, moving that many people out of poverty that quickly, it's a complete anomaly. It's an economic miracle driven by that exact global free market we were just discussing.
Okay, hold on though. I have to push back on this a little bit on behalf of anyone listening who is currently dealing with, inflation, job insecurity, or just wild market volatility.
Fair enough.
Because it is incredibly easy for a highly successful billionaire investor to sit back and tell the rest of us to just zoom out and realize how lucky we are in the grand scheme of history.
Yeah.
Like, does this perspective actually translate into a practical edge, or is it just kind of toxic positivity for the ultra-wealthy?
I get that. It definitely sounds like toxic positivity at first. But when you realize what this mindset actually accomplishes functionally, it changes things.
How so?
Well, if we dig into his philosophy, this isn't just an empty feel-good mantra. He is describing a strict psychological prerequisite for extreme rationality.
Okay, unpack that for me.
Li Lu has a glass-half-full creed, but it is rooted in a very humble, difficult admission. He says that in any grand success, luck plays a far, far bigger role than the human ego likes to admit.
Oh, wow. Yeah, we all desperately want to believe our success is 100% due to our own unique brilliance.
Exactly. But he's saying it's mostly about being born in the right place at the right time and catching the right historical wave.
And I guess genuinely recognizing that fact would be incredibly liberating.
It is. He talks about maintaining a normal heart, which essentially means not taking yourself too seriously. Because think about what drives most people in business.
Usually insecurity.
Exactly. It's the constant burning fear that they aren't smart enough, rich enough, or successful enough compared to their peers. And that insecurity is dirty fuel.
Right. It might propel you to work 80-hour weeks in your 20s, but it ultimately leads to burnout.
Burnout and, more importantly, terrible emotional decision making.
Ah. So by accepting that luck is a massive factor and choosing not to complain about the historical bumps you can't control, you stop wasting mental energy. You aren't constantly fighting your own ego.
You free up massive amounts of cognitive bandwidth, and in the business of investing, where literally everyone you are competing against is already a genius, raw intelligence isn't the differentiator anymore.
It's temperament.
Exactly. The person with the clearest, most rational, least emotional mind wins.
Which perfectly sets up how that clear, rational mind actually picks winners in the market. So let's look at the actual engine behind his success, the vaccine of value investing.
Yeah, the vaccine. It's funny because Lai Lu actually discovered Warren Buffett completely by accident shortly after arriving in the U.S.
Really, just stumbled onto him.
Yeah, he just attended a lecture, heard Buffett speak, and it was an absolute revelation for him. He started his investment firm straight out of school and has been executing this exact strategy for almost 3 decades now.
And the source notes that he calls value investing a vaccine because it either takes immediately or it never does.
Right. You hear the core concept, and your brain either instantly accepts that this is the only logical way to invest, or you spend the rest of your life treating the stock market like a casino, just constantly chasing quick trends.
And what that vaccine requires of your temperament is immense discipline. I mean, you must prioritize cold, hard facts over whatever the market consensus is currently screaming at you on the news.
And critically, you must be entirely comfortable getting rich slowly.
Getting rich slowly, because the core math of value investing is actually quite elegant, isn't it?
It is. The true value of any company isn't what the stock chart did yesterday. It is simply estimating all the cash that the business will generate over its entire lifetime and then discounting it back to what that money is worth today.
And I feel like that concept of discounting is where a lot of people trip up. But it's actually pretty intuitive when you break it down.
Yeah, it's just based on the time value of money. Like $1 in your hand today is worth more than $1 promised to you 10 years from now.
Right, simply because of inflation and opportunity cost. I mean, you could be investing that dollar today to make more money.
Exactly. So to figure out what a company is actually worth, you have to project all the cash it will make in the future and mathematically shrink those future dollars to see what they are actually worth to you right now.
But the absolute biggest threat to those future cash flows is competition. Because capitalism is brutal. If your business is making a fantastic profit, someone else is going to see those margins, enter the market, and try to steal your customers by doing it cheaper or better.
Which brings us to the single most vital concept in value investing. The moat.
The moat.
Yes, the competitive advantage that acts like a deep trench around your economic castle, keeping all those invaders out.
And moats can look very different depending on the business, right?
Yeah.
Like sometimes it's a literal monopoly, like a local utility company where they are the only option.
Sure. Or sometimes it's cutting-edge technology that's protected by ironclad patents.
Right. But a moat can also be something less tangible, like an impenetrable corporate culture. Think about a company like Costco.
Oh, that's a great example.
Yeah, their entire internal culture is so fanatically obsessed with driving prices down for the consumer that it becomes structurally impossible for a competitor to undercut them without just going completely bankrupt. That culture is a massive, highly effective moat.
And when you combine the discipline to find those deep moats with the patience to just let them grow, the results are staggering. I mean, Li Lu points out that Berkshire Hathaway's stock went from around $20 a share in 1965 to well over $300,000 today.
That is just absurd.
And that didn't happen by taking wild risks or swinging for the fences on unproven startups. It happened through a steady annual return of around 18 to 19%.
Einstein famously called compound interest the eighth wonder of the world. For a reason. It is literally a mathematical miracle when you apply it over decades.
It really is.
But you know, we always hear about money compounding. What I find truly fascinating in this source material is the concept of knowledge compounding.
Oh, yes. The mental snowball.
Exactly. Think of it like a mental snowball rolling down a very long hill. If you spend 50 years studying thousands and thousands of different business models, and you process all that information using a strict, rational framework, your pattern recognition becomes an absolute superpower.
Because every single business is a unique puzzle. So the work of studying moats never actually gets repetitive. The value investor's learning is truly infinite.
And contrast that with other highly technical fields where your knowledge actively decays. Like, if you were the world's leading expert in flip phone technology in 2005, your hard-earned knowledge is practically useless today.
Yeah, the market moved on.
But in value investing, human nature and the fundamental mechanics of business, they don't change.
You accumulate this massive mental database of what works, what inevitably fails, and exactly how human nature operates under extreme pressure. It's why value investors in their 70s, 80s, and 90s are often at the absolute peak of their game.
Their judgment actually leaped to new levels as they age.
It really does.
So how does someone actually apply this philosophy to their own life and wealth?
Yeah.
Looking at how Li Lu structures his own fund gives us a huge hint, I think,
Mm.
because he operates on a model of absolute alignment of interests.
Yeah, his fee structure is fascinating.
It is. He charges zero management fee, meaning he doesn't get paid just for holding your money. He only shares in the profits after the fund clears a 6% return hurdle.
And on top of that, he keeps 100% of his own personal investment capital inside his fund.
So he only wins if his clients win.
Exactly. He is eating his own cooking. And based on that deep philosophy of alignment and understanding, he outlines a clear 5-step hierarchy for how individuals should approach building wealth.
And the order of this list is crucial. So, step 1, at the absolute top of the hierarchy, invest in your own business.
That makes perfect sense when you think about the moat. If you own the business, you control the machine. You have the deepest possible understanding of its competitive advantage, and your interests are perfectly aligned with the outcome. So if it has a moat, your capital should go there first.
Step 2 is the next best thing. Pick a very small handful of companies that you deeply, thoroughly understand. You don't need to own 50 stocks. Just a few where you can clearly see and verify their long-term competitive advantage.
And if you don't have the time or expertise for step 2, you move to step 3. Find a manager whose interests perfectly align with yours.
Right, so you are essentially outsourcing the deep work to someone who treats your money exactly like their own, using a proven, rational method.
Exactly. Then step 4 is for when you acknowledge you don't have an edge in picking individual companies or managers. Buy broad index funds. You just buy the whole market.
Although he does add a specific caveat for the Chinese market here, noting that because of how their exchanges are historically structured, a simple index doesn't capture the whole picture.
Right. He says it requires a curated approach combining U.S., Hong Kong, and domestic listings to truly capture their economic engine.
Good to know.
Yeah.
And finally, step 5, hold cash.
Hold cash.
Which sounds completely counterintuitive, right? Because inflation eats cash.
Yeah.
Why is holding cash a strategy?
Because you have to compare it to the absolute worst choice you can make, which sits at the very bottom of the hierarchy: blind speculation. Trading on inside tips. Trying to time macro market swings, treating the stock market like a casino that is guaranteed destruction of wealth over a long enough timeline. Cash might lose a few percentage points a year to inflation, but blind speculation will completely wipe you out. Doing nothing is mathematically better than setting your money on fire.
And, you mentioned blind speculation wiping you out. If you want to apply this kind of deep, rational analysis to your own financial journey and avoid that speculation, we have a way for you to do just that. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. To track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.
And honestly, having tools that focus on data is exactly how you build the discipline to avoid the speculation the source warns against. It forces you to look at the actual temperature of the market rather than getting swept up in the emotional frenzy of the crowd.
Which circles us perfectly back to the psychological fuel required to actually pull this off for decades. We talked earlier about how insecurity and ego are terrible, dirty fuel that leads to burnout. So what is the clean fuel? Like, what sustains a value investor for 50 years?
It comes down to 2 things: love and curiosity.
It sounds incredibly simple, almost poetic, but it's a profound operational advantage.
It really is. Because if you are going to spend half a century painstakingly reading annual reports, studying supply chains, and watching markets violently fluctuate, You cannot fake it. You have to genuinely love the game.
You have to be deeply, fundamentally curious about how the world works.
And there is an amazing anecdote in the source material that perfectly illustrates this. Leo Liu talks about a phone call he had with Charlie Munger when Munger was 97 years old.
Let's picture that for a second. At 97, almost all of Munger's peers had long since passed away. It would be so easy to become cynical, bitter, or completely disengaged from the modern world.
But instead, they were on the phone for 40 minutes, vibrantly discussing the specific biological mechanics of the Pfizer COVID vaccine, marveling at how it achieved a 90% efficacy rate.
Wow.
A 97-year-old billionaire, still endlessly curious, still trying to deeply understand a brand new complex variable in the world. That level of curiosity is the ultimate defense against aging.
It really is. So let's pull all of this together for you listening. We've traced the massive macro friction of our runaway global startup. We've looked at the micro-survival strategy of zooming out to view the grand forest of history, freeing ourselves from ego and insecurity.
Right.
And we've unpacked the granular mechanics of how a rational mind compounds wealth and knowledge through the relentless search for economic moats.
If there is one overarching theme tying it all together, it's the undeniable power of maintaining a calm, rational, and curious mind in a world that is constantly trying to pull you into emotional chaos.
Before we wrap up, you always have a way of pulling out one final thread from our sources to leave us thinking. What stands out to you the most from Li Lu's philosophy?
You know, there was a brief, almost passing comment Li Lu made toward the very end of his talk that really anchored the entire perspective for me. He noted that from a cosmic perspective, even the universe itself has a life cycle. It has a birth, a lifespan, and eventually an end.
You literally cannot get more zoomed out than the lifespan of the universe.
Exactly. If the universe itself has a lifespan, and we are just tiny humans subject to ruthless, unstoppable cosmic laws, then wealth, status, and the daily friction we stress over are truly things we cannot take with us.
Wow.
So the real compound interest of a well-lived life isn't actually your bank account. It's your curiosity. It's the joy of figuring things out while you are lucky enough to be here. So the question to leave you with today is this. What is one complex, intimidating thing in the world right now that you can choose to look at with genuine love and curiosity rather than fear?
That is a phenomenal question to carry with us. Thank you for taking this deep dive with us today. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice. Conduct your own due diligence before making investment financial decisions. Don't forget to like this video. Much appreciated. We will catch you on the next deep dive.